Welcome back to the Graham Stephan Show, and I just got called out by Aaron Talks Money. Apparently in a prior video I said something that she disagrees with, so I want to disagree with her disagreement. As soon as you hit the like button and subscribe, because it helps out tremendously, and with that said, let's get into the video here. Here's exactly what she said.
I want to start this video a little bit differently. Recently, a video popped up on my feed from MoneyWise titled 10 million versus 100 million, the difference between being rich and really rich. Actually, I found this by way of Graham Stephan, whose video was titled Why You Never Need More Than $10 Million.
This is exactly why, by the way, you subscribe to this channel, because I probably spend like 5 hours a day scouring YouTube for the best videos out there, and when I find a true gem, I react to it on this channel. So if you want to not miss those videos, subscribe. It's totally free. So thank you. We'll get back to the video.
What I found most interesting in this data was not the net worths. It was not the income. Rather, it was the spending. For households with a net worth of under 1 million, the median monthly burn was about $9,500 a month. When you move into the 1 to 5 million and $5 to $10 million net worth ranges, the median burn increased to about $15,000 a month. And I think what we can take away from this is that even at a high net worth and with a high income, spending eventually levels off.
Here's the thing though, a lot of the people with a really high net worth have that money tied up in a company that's illiquid, that they can't quite sell, or it's in private equity that looks really good on paper, but you can't spend it. You can't spend private equity. Like I could say, oh, my YouTube channel is valued at $30 million because of all the branding, but it means nothing when it's not, like, I can't go and sell it for that price. If someone wants to pay me $30 million for my YouTube channel, absolutely, give me an offer, I'll take it. But beyond that, the value of the channel is really just a vanity metric. It means nothing if you can't get that price in cash. So that is why the spending doesn't scale with net worth in these charts here.
You buy the house you want, you furnish it, you take the trips you want, you make the upgrades you want in life, but at a certain point, that's it. Even as income increases to the $500 or $1 million per year range, paired with net worths of 10 to 20 million or 20 to 50 million, the median monthly spend is around $25,000 a month. You get to the point where you've bought everything you need and spending still kind of levels off.
It's really hard to spend more than 30 grand a month. I mean, I know it sounds crazy to say, but unless you are out there spending money at the club, being reckless, going out to dinner every night, showering, just people with money, just throwing bills everywhere, just being irresponsible with it. If you're like a well-rounded person and you're trying to do like high-end things on a regular basis, like 30 grand a month in discretionary spending, my gosh, imagine every day for the rest of your life, you got to spend $1,000. How do you do it? After a while, you just want to go and eat at Chipotle. After a while, you just want to go and be on the couch and watch a free Netflix show, watch a YouTube video, go and just do nothing, scroll your phone. Because after a while, you just get tired of going out to these crazy restaurants. And don't get me wrong, like the crazy restaurants are nice. I've tried doing this a few times, and after a while, it's just like, I want to stay home. I'm a homebody too, so that also helps save you money. If you just like staying home all the time, think of all the money you could save. And then you could spend it on investments.
At a certain level of wealth, $1 million more just doesn't move the needle that much. If you go from a net worth of $500,000 to $1 million, you're going to feel that. That's going to give you a greater level of confidence and security and meaningfully increase your spending. But what if you already have a net worth of $8 million? How much does it change your life to get to a net worth of $9 million? Probably not that much.
Here's the thing though, beyond a certain point, you stop looking at increases in terms of dollars, but rather percentage. Because going from 0 to $1 million, oh my gosh, that's a world of difference. But going from 20 million to 21 million, you don't even notice it. That's a few good days in the market. So when you start looking at things in terms of percentage, going up 50% is a lot of money if you're worth 100 million, 50 million, 20 million, 10 million, 5 million, 50%'s a lot. 20%'s a lot, 25%'s a lot. So when you start looking at things in terms of percentages, puts it into context.
So often in the comment sections of so many of these videos, I see comments like, you can't retire if you don't have $10 million, especially in a high cost of living area. And for the vast majority of retirees, and I can't even believe I'm saying the sentence, that is far more than they'd truly ever need. But I feel like there's a lot of fear-mongering in the financial community. There's such an emphasis on having a portfolio that is bigger and bigger and bigger, and never stopping to ask why.
Well, I'll tell you, the reason why is because for most guys out there, the amount of money in your bank, your net worth, is like a scorecard of how well you're doing in terms of your accomplishments. I'm not saying that's the right way to do it. In fact, it's probably the wrong way to do it. But for a broad category of people, they see, okay, if I do X effort and I have X dollars, the dollars are my rewards. They're my trophies. And so every 100,000 trophies I get, there we go. I've just leveled up. And it's something that people can measure. It's like counting their calories, counting reps, seeing how heavy they could lift at the gym, going from like 80-pound presses to like 85. You see the improvement. And for a lot of people, the thing that they can measure is dollars. They could measure how much money they made. And so that's why people see, okay, I get $10 million, but I could get a little more. And it's never ending. Again, it's not healthy, but that's the reason why.
So let's walk through an intentionally aggressive example, spending $25,000 per month. Say we have a household at full retirement age earning $72,000 a year from Social Security. So for this retiree, we're going to assume an effective tax rate of 35%. That's fairly reasonable at this income level, so to net $300,000 after tax, we'd need roughly $460,000 of gross income. Social Security already provides $72,000 of that, which means the portfolio needs to generate about $388,000 per year.
Here's the thing though with this math, is that not all the money you pull out is going to be profit, because you're going to have a cost basis in there. So if, for instance, you have $1 million invested that's now worth $1.5 million, well, guess what? If you pull the money out, you're not going to have to pay taxes on $1.5 million, because you already paid taxes on the million. So in most cases, your actual tax rate is going to be significantly lower than this, and this is actually a really high tax rate, in my opinion.
If your goal is a comfortable and flexible and secure retirement, this goal is well and above and beyond what the typical household would need. And that's the point of this exercise. We're looking at the uppermost limits. And if we look at this number as the ceiling, we can start to think about, are people chasing a number that is higher than what they truly need to live the life they want?
Okay, I'm going to spit some facts here, and you're not going to like these facts, but this is just what the data says. In retirement, people think that they're going to spend all of this money and they're going to live this lavish lifestyle, and if they work their entire lives and they save up a ton of money, and then guess what? What actually ends up happening is that you end up spending a lot less money than planned. Why? Because of health issues. Because the older you get, the less able you are to take crazy trips, to go on these nice vacations, to do these outdoor activities. Most people, I hate to say it, they end up withering. They do nothing. So I would venture to say your prime spending years are probably going to be in your 50s and 60s, and then most likely in your 70s, spending drops off a cliff, and unless it's healthcare related.
If you look at the data, households within the $1 million to $10 million net worth range often have median take-home incomes around $325,000 to $350,000. That's what I would reasonably call a wealthy household. What's interesting is that their median monthly burn is about $15,000 a month or $180,000 a year.
A lot of these returns later in life, by the way, are just going to come down to investing as soon as possible. Like, you see all these charts out there showing of like how much money you would have if you invested at 20 versus 25. And every single chart shows that the earlier you start, the better. And I'm going to ask a huge favor of you, because I have just partnered with Public.com. They're competing with some of the biggest names in the investing space, and they've reached out to me to see if we could get some additional signups. So how about this? If you want to make me look good, that's all I ask. Just make me look good. Check them out with the link down below in the description. Sign up, make an account. It's totally free. And just let me know what you think of them. For those unfamiliar, they just have a really good platform. I've been using them legitimately for the last few years now. They have commission-free trading, $0 options contracts, low margin rates. There's no payment for order flow. They have stocks, bonds, crypto, treasuries, everything in one place. So if you want to just give them a shot, and again, just make me look good. I just want to give them a good result, and totally free. It'll take you a few minutes to sign up. The link is down below in the description, and it would mean a lot to me. And did I mention it's free? So if you want to be a part of it, again, the link is down below. I've rambled on long enough. So I really appreciate it. Thanks for doing me a favor, doing me a solid here. We'll get back to the video. Thank you.
We'll assume $72,000 a year from Social Security, with one spouse receiving $4,000 a month at full retirement age and the other $2,000 a month. For a household with two high-income earners, it very well could be the situation that their Social Security payout is even more robust, but we're going to keep it a little bit more conservative here.
Dude, that's also assuming Social Security is even solvent. My gosh, they have so many issues with that. So what's going to end up happening is that they either have to deny benefits, which they're not going to do, okay? So that's not going to happen. Or they're going to tax more of your working years to pay for it, or we're just going to go deep into debt. So something's going to happen there. Social Security system right now, it's basically a Ponzi. It's going to break, okay? Something has got to happen to keep it afloat. It's a horrible system. We would just be better off, honestly, if they just pull like 8% of your paycheck just automatically off the top. Like you pay the tax, but that 8% tax basically just gets invested into an account for you in a broad mixture of funds that you can't touch until you're 65. I think so many people would be a lot better off just doing that, and then the money's yours. And if you don't contribute to it and you opt out, then that's your fault. But if you do opt into it, then it gets invested and it's there. I would love to see something like that, because as it stands right now, the Social Security system is awful.
Using a 4.7% withdrawal rate, you'd need a portfolio of about $4 million. $4 million. Yes, that's a large portfolio, but it's not unthinkably large, and more importantly, it's grounded in real spending data, not just assumptions.
Here is exactly how you can make $4 million. If you're 20 years old, all you got to do is invest $750 a month consistently at an average market return of 8% a year, and by the time you're 65 years old, you're going to have $4 million. That's it. $750 a month. Find a way. Do anything you can to make an extra $750 a month just for the purposes of investing. Live with roommates. Take on some part-time work. Do anything you can. Just $750 a month on average, starting at the age of 20. That's it. If you could do that, just that, you spend everything else you make, just do that. You have $4 million at retirement. There you go. That is it. Just start investing as soon as possible. Done.
Let's introduce a little bit more realism to this situation. Let's say this retiree wants to retire 10 years early. Phase 1, the early retirement bridge. Because this phase is only 10 years long, we're not locked into ultra-conservative withdrawal assumptions. Research shows that for shorter, defined time horizons, withdrawal rates in the 8 to 10% range can absolutely be reasonable. We'll split the difference and assume a 9% withdrawal rate.
We ain't getting 9%. If someone comes to me and they say, hey, I want to take 10 years of my investments and I'm going to take 9%, I would say, no, you don't do that. No, because here's what happens. You have a sequence of returns risk. And what's going to end up happening if you start taking 9% off the top and the market goes down those first few years, you are fucked. You are messed up. No. So I would say if you have 10 years, it's a lot more realistic to say, I'm going to take 5%, take 6%. Even that, I say, is pushing it. I would not be taking almost 1/10 of your portfolio every year for 10 years. Because again, if you get a lost decade, your portfolio is done. You are out of the game. But you know what? That's me. And if we're going to have drama over whether or not you withdraw 5% over 9%, bring it on, okay? I just think incredibly risky. I wouldn't recommend. But then again, I'm very risk averse. I like going into something thinking I have a strong conviction, 99.9%, going to be just fine. I'm not going to do a 50-50. I might have to return back to work. I don't want none of that. To me, 9% too risky.
Here's what that declining withdrawal would look like once you layer in Social Security. In year 1, their gross income would be $260,000. Year 5, $253,000. Year 10, $244,000. Year 15, $235,000. Year 20, $227,000. What we see here is that spending is declining gently. There's no abrupt changes, and Social Security really does act like a stabilizing force. And that $3.1 million portfolio, that's what's needed 10 years from now, when Social Security begins.
We just have to hope a few things. Number one is Social Security is still around, which Debatable, but I would say more than likely. There's a good chance it will be, but there's also a good chance that something is going to come up because it has to. There's going to be some sort of change to Social Security. We don't know where it's going to come from, but it's going to happen. The other thing is that you have to hope that you don't have any major health emergencies or anything in the future that is going to demand more money. We don't know if, at some point, the US dollar is no longer the reserve currency. We don't know how the economy is going to act. We don't know if everyone's just unemployed at that point and AI robots are taking over. We also don't know if money just becomes irrelevant at this point, and none of this matters because everything is so cheap, because robots are just making robots doing everything for us, and we got one robot per household who's just like cooking, cleaning, doing everything you need. They're their own doctor. Maybe you don't need money anymore. I don't know. But I like to prepare for the chance that AI just wipes us all out, and it's better to have more than less.
To me, this is really the most important thing to sit with. The idea that the most you might ever need to live a comfortable retirement, to take vacations, to dine out, to spoil the ones you love, realistically might be around $4 to $5 million. That's a big number. Yes, it's aspirational. It's not the everyday household we're talking about, but it very well could be the high income earners, those pursuing an early retirement, those pursuing financial independence with every ounce of their being.
Or it could just be the person who is watching right now who decides that they can invest $750 a month for the next 45 years and just in a broad index fund, get 8% a year, and just ride it out. It just comes down to consistency and knowing exactly what to look for. And one of the ways you could actually do this, by the way, is through a company called WizeFi. I've been working with them now for about 2 years, and they aggregate everything in one place to help you achieve financial independence. I'm talking income, spending, net worth, expenses, and this is something I was doing myself, by the way, for years until eventually Mint.com shut down. I was really upset. Then WizeFi stepped in. They were trying to replicate that, but even better. And without exaggeration, when it comes to achieving financial independence specifically, they are so comprehensive. I will tell you, by the way, it takes you a little bit to get it set up and running because it's pretty detailed. So if you want to start saving, even just like $750 a month, I would highly recommend something like that. I'll link to them down below in the description. Try it out. They're even open to feedback, so you could literally just email. I'll put it down below in the description if you have any feedback for that. Like, they're so open to anything they could do to improve. So enjoy and save that $750 a month.
But that number is far more realistic than many of us are told. Often we're told that true financial freedom is only achieved at $10, $15, or $20 million, maybe even more. But in reality, for most people, it's unlikely you'd ever need anything beyond this to afford the life you actually want to live. A life where you can comfortably say yes to all the things that matter to you. And no, at this level of wealth, you're not flying private with a private chef and a full entourage, but you're also not doing that at $10 or $15 million either.
I'm going to be honest, okay? I tend to think that true financial independence comes around $10 million. I think it costs that. And the reason I say that is because at $5 million, you are still at the whims of the overall economy. Now, I'm not saying it can't be done. You could buy a $1 million house, you could have $4 million in investments, but I'll tell you, if the economy goes down, if the markets drop 50%, you're going to start to worry. You're going to start in the back of your mind, your wheels are going to get going. Oh no, what's going to happen? What if my withdrawal rate is going to exceed what the market does over the next few years? I tend to think 10 is the point where those feelings start alleviating a little bit. You're a little less concerned about what's going on in the economy. You're a little less concerned about, is AI going to disrupt everything? You have a little more freedom to spend money as you please. You could get first-class plane tickets occasionally. You could splurge on a slightly nicer car. I'm not saying everyone needs those things. And it really also depends on where you live. If you're in New York, Los Angeles, San Francisco, some high cost of living areas, yeah, even 10 million might not be enough to live put kids through private schools and stuff like this. But I tend to think 10 is the point where you have such a margin of error there that you could make some hiccups along the way. You could screw up a few times. You could make a few bad investments and still be fine even if the economy turns down. That's what I think. Can it be done at 5? Certainly, but you can't screw it up. We'll put it that way.
So maybe this is an invitation to step back and do a different kind of exercise. Rather than picking a number out of thin air like 10 million or 20 million, write down what you think your loftiest ideal spending could ever be. Not your typical spending, your loftiest, highest spending, and work back from there. You might find that your most ambitious version is entirely feasible and entirely achievable sooner than you ever thought.
The other thing though is it always goes up. You always hit the number and it's like, well, that's not as crazy as I thought. Let's get a little more. And then you get to the higher number, the market goes up, and you're like, well, the market could always go down. I guess the saying of wherever you go, there you are is very true. Your mindset today is probably going to be the same mindset you have with a little more money, except with a little more comfort built in. So how about this? If you want to get started investing, make me look good. That link is down below in the description to sign up for public.com. And just let me know what you think. So with that said, that link is down below. Thank you for giving it a shot, trying it out. Make sure to hit the like button, subscribe, and don't forget, by the way, check out Erin Talks Money. I'll link to her channel down below in the description as well. Really enjoy her channel. So with that said, thank you so much. Until next time.